Dr. Dahle, thanks for spending the evening with the ACEP members and offering up some advice.
You're very welcome. It's wonderful to be here.
I got this earlier today. Should I contribute to 457B on top of my 403B? What are the advantages and disadvantages of the 457B?
Well, first let's start with a little bit of a disclaimer. Most of the people listening to this probably aren't in Utah, and I'm not actually licensed to do anything outside of Utah. And even in the Utah, I'm only authorized to, practice medicine and drive. So just bear in mind, I am not a financial advisor. I am not an accountant. I am not an attorney. And so this entire presentation is for your information and entertainment only. Make sure if there's something that doesn't sound right to you, that you look it up and check with a reliable source and double check it. All right. But as far as 457Bs, this is a common question among physicians, particularly academic physicians, because a lot of academic physicians will offer you both a 403B, which is very similar to a 401k, and a 457B, which is not at all similar to a 401k. It has similar limits to a 401k and a 403B, but it has one big difference, and that difference is that it is not owned by you. It is owned by your employer. So while that offers great asset protection for you because it's not your money, if somebody sues your employer or your employer goes bankrupt, that money is available to their creditors. So the governmental ones are usually pretty stable, and the non-governmental ones are problematic. You really want to be careful and make sure it's a stable employer if you're going to use that one.
Excellent. I have a question here that says, when I did my contribution to the traditional IRA through Vanguard, I had to wait 6 business days before I was able to make a conversion to my Roth IRA. This was confirmed twice with the Vanguard customer service representatives. Is this normal?
It was pretty normal this year. A lot of people had that trouble. I think I had to wait 2 days. In the past, I've only had to wait 1. But I had 1 year, I think, that made me wait 4 or 5 days. It's really not that big of a deal to wait a week between the contribution and the conversion step for a backdoor Roth IRA. So I wouldn't spend too much time worrying about it. I mean, basically, you just leave it in the money market fund there for a few days and you make $1 or $2 of interest. And then you roll the extra $1 or $2 of interest into the Roth IRA and you owe taxes on $1. It's no big deal. So I wouldn't sweat it too much. But obviously, if the market goes up in that first week, that's kind of lame that you couldn't get it into the investment right away.
Here's one we have. It says, once a physician retires, how do you plan to take out the funds from which account first, taxable or non-taxable? As IRAs RMD at 70.5, what happens once a physician is no longer saving money, but instead taking out the money?
Well, in general, the general rule in this sort of scenario is that you spend the taxable money first. And then you leave the retirement accounts to compound in a tax-protected way as long as you can. That includes both Roth IRAs and tax-deferred or traditional accounts. So the general rule is taxable first. But it's nice to have options in retirement. This allows you to take advantage of tax diversification. You've got some money from taxable, some money from your tax-free or Roth account, and some money from your tax-deferred account. What that essentially lets you do is choose your own tax rate in retirement. So the typical strategy, at least once you burn through the taxable money, is to take out tax-deferred money up to the top of the next bracket. And then above and beyond that, if you want more income or more money to spend in retirement, you use the tax-free or Roth money above and beyond that. And so that's the general strategy. But starting at age 70 and a half, you have to start taking out required minimum distributions from 401ks and any tax-deferred accounts like IRAs. And that works out to be at age 70, 3.6% of the account, which is about how much you want to be spending anyway. So it's not that big of a deal that you have to take those out because that's about what you ought to be spending from the account anyway, unless you want to just die with a ton more money than you have. RMDs, people have a lot of fear of them, but it actually isn't a bad way to just spend your money in retirement.
You might have already sort of answered this. It's kind of a part 2 to the last one. With respect to Social Security, if the physician makes money and the spouse does not, when is it best to take Social Security money, assuming delaying results in a higher return and the money is not essential for the spouse who doesn't make money and the spouse who does but is 2 years older?
Well, this is actually a very complex situation. If you're healthy and you're single or you're divorced or whatever, the usual answer is to take it at 70. Just because that gives you the maximum amount of a longevity protection, basically the risk that you'll run out of money. Because the longer you wait, the higher the payments are. So the general rule in that situation is wait till 70. However, if you are married and you're both going to be getting a benefit of some kind, which you generally are, either your own or your half of your spouse's, the strategy is not nearly as clear cut and can be a lot more complicated. The best resource I know to help answer that question for your individual situation is a little book called Social Security Made Simple. It's written by Mike Piper. It's 100 pages, and you don't even have to read the whole thing. You can just pick the chapter that answers your question. So I'd recommend picking that up. It's $5 or $6 on Amazon. It's no big deal. Social Security Made Simple. But a lot of times it does make sense for the lower earning spouse to take money earlier than the higher earning spouse, and for the higher earning spouse to wait until age 70 to take that money.
Let's take a little bit of a break from the routine here and ask how you got started in this and how did you become an expert? We're almost to 7, so I think we're about to like 66 people right now. How did you get into this?
Sure, I think the real answer is I got sick of being ripped off. About halfway through residency, I think I had already been ripped off by just about every type of financial professional there is. A realtor, a mortgage lender, a recruiter, a financial advisor, an insurance agent, you name it, I'd had a bad experience with them. And when I had that happen again with a financial advisor in residency, I realized if you don't start learning this stuff, this is just going to keep happening your whole career. And so I decided I'd go across to a used bookstore that was by my house there in Tucson, Arizona, and start reading books. So I started getting books and started reading them. I read a lot of terrible books, terrible financial books there are out there, but I did find a few good ones. And as I went along, I realized this stuff isn't nearly as hard as medicine. And I also found it interesting. And so over the next few years online, I asked questions and answered questions, and found after a few years that I was doing a lot more helping than I was being helped. And just realized that that wasn't really the best way for me to help the most amount of people out there. And I realized that nobody was teaching this to doctors. So in 2011, I started The White Coat Investor, which is a blog, which has since grown into the most widely read physician-specific personal finance and investing website in the world. And, obviously it's grown into a lot of other things, webinars and podcasts and video casts. And we have a live conference. I've got a couple of books I've written, and an online course, and go out and do speaking events and do all kinds of things, mostly just to try to get this information into the hands of those who really need it, which are doctors. And the interesting thing about learning this stuff is the first few things you learn are so high yield that it easily pays for your time and effort taking a look at it. And so that's kind of a passion of mine, it turns out. Just as much as I love medicine, I like helping doctors and other high-income professionals quit doing dumb stuff with their money.
We hear this question a lot, especially because I work with the young physicians section. What are a couple of mistakes that young people make, particularly as soon as they get out of residency and then they start, making a pretty good paycheck? What are a couple of things that you would advise against for those graduating residents?
No, you're just teeing that up for me. That's my specialty here. One of the biggest mistakes people make even earlier than that is having the wrong kinds of insurance or not having enough of it. So one of the big things, if I can talk people today into doing anything, is go get some disability insurance. If you rely on your income for your living expenses, you need disability insurance. If you haven't bought it yet, go buy it. Basically, your first month of internship is about the time to buy it. So that's number one. If you don't have enough insurance, go take care of that. If anybody else is relying on you, you also need a big fat term life insurance policy. And I'm not talking about a couple $100,000. I'm talking about a few $1 million. $1, $2, $5 million, that sort of an amount is the typical amount a doctor probably ought to be carrying early in their career. So once you get beyond the insurance, one of the biggest mistakes doctors make, particularly emergency physicians, who often only really have one raise in their entire life as they leave residency and become an attending, is they just grow into their income way too fast, and sometimes beyond it. I'm amazed how many doctors, by the time they graduate from residency, have 2 car loans and a big fat mortgage payment, and then they realize they got to start making real payments on their student loans. And so all of a sudden, from the beginning of their career, they're just swamped with debt payments because they're simply spending too much money. And they never carved out anything in the beginning of the career to build wealth, to pay off the student loans, etc. So my very best advice, if I can put it into one phrase that I can give to any doctor, the secret to wealth as a physician is live like a resident. If you'll just spend the first 2 to 5 years of your career living a lifestyle somewhat similar to residency, heck, give yourself a 50% raise even, right? That'd be huge in corporate America. But if you can live on $50,000 or $75,000 a year and earn the $300,000 or $400,000 or $500,000 that many emergency physicians are earning, and take the difference there and use it to build wealth, you can wipe out your student loans very quickly. You can catch up to your college roommates as far as retirement savings, and you can save up a down payment on your dream house. So really the key is that first year out of residency. If you can just get that started right, so much just goes great for the rest of your financial life. And that'll make up for almost any other financial mistake you ever make.
We just got a question from one of our attendings in the webinar. It says, what's the #1 book that you would suggest for a newbie investor?
I think the best book to start with is not written by me, actually. I have a couple of books out. I have The White Coat Investor, A Doctor's Guide to Personal Finance and Investing. That's the one that came out in 2014. And the one published less than a month ago, which is The White Coat Investor's Financial Bootcamp. They're excellent books. Either one of them will help you a great deal. But the one I recommend to people that aren't sure they can get through a financial book is written by neurologist William Bernstein. It's titled If You Can. It's free. It's 16 pages long. That's it. You can get through that. If you just Google right now, If You Can PDF, it'll pop right up. And you can have that read by the time this presentation is over. Now, to be fair, that book does recommend you read 5 other books. It's divided into 5 or 6 chapters, and each chapter, one of the homework assignments is go read another book. But in 16 pages, it encapsulates a very viable investing strategy that you would do well to follow the rest of your life. Investing really can be that simple.
Excellent. I have one here that came in advance. Can you compare the ultimate benefit of putting monies into a taxable account, paying the taxes up front, versus a tax-deferred account, an IRA, where the tax is ultimately paid at a higher earned income rate upon withdrawal?
You know, this is an area of confusion that a lot of people have. They start thinking, well, what if I have to pay all these taxes when I take the money out? But they forget about that huge tax break they had when they put the money in. I think one of the best ways to understand retirement accounts is to first think about a tax-free or Roth account. When you put money into a Roth account, that money is never taxed again. All the earnings throughout the years are not taxed, and so it grows quicker than money does in a taxable account that has that drag from the constant taxes each year as it pays out dividends and other capital gains distributions. Then when you take the money out in retirement, it comes out tax-free. That's a Roth IRA, a Roth 401k, a tax-free account. Now, the best way to think about a tax-deferred account is that it is really 2 accounts. The first part is all yours. It's just like a Roth account. It's a tax-free account. The second part of the account is a government account. It's the government's money, and it's money that you are investing on their behalf for the next 10, 20, or 30 years. So if you think about it that way, you realize that that money you pay in taxes when you take the money out of that 401k or IRA was never your money in the first place. It was government money. And a lot of times, because we're often in a higher tax bracket during our peak earnings years than we are in retirement, we even get some of that government money transferred into our part of that account. And so I think if you have that mindset about it, you won't stop for a second and think that it would be smarter to invest in a taxable account until after you have maxed out all available tax protected accounts. That includes backdoor Roth IRAs, that includes health savings accounts, that includes 401ks and 403bs and 457bs. And if you have a side gig, an individual 401k, and maybe if your employer offers it or your partnership offers it, a defined benefit or cash balance plan. So all of those are superior tax-wise, much superior to investing in a taxable account. It's not that a taxable account is a bad thing. If you need to invest more money for your goals, retirement or college or any other goals, that's not a bad place to put it. But bear in mind, it is not as good as using your 401k.
Excellent. Here's one that just came in. When people refer to having bonds in their portfolio, are people generally referring to a total bond market fund?
I think there's a lot of variation in what people are referring to, right? I mean, obviously, there are lots of different ways to invest in bonds. You can invest in a bond mutual fund. You can buy individual bonds, particularly with treasuries. That's relatively easy to do if you go to treasurydirect.gov. You can buy them straight from the government. So a lot of people that are building a treasury bond ladder or who buy individual treasury inflation protected securities will go there and buy those directly. Sometimes people will even hire a broker to help them choose individual muni bonds, but I think that's a level of hassle that's probably not worth it, given how cheap it is just to go to Vanguard and buy a municipal bond index fund, for instance. And so it depends. You know, a lot of people do use a bond fund like the Total Bond Market Index Fund. That's not a bad fund, but a lot of times they're using something different. I don't actually invest in the Total Bond Index Fund. I have a little bit different strategy for my bonds, but it's not like that's a bad one. The truth about investing is you need a reasonable strategy that you can stick with for the long term, and you don't want to be bouncing back and forth between a bunch of different reasonable strategies. You'll probably move from one just as soon as it starts doing better than the other, and vice versa. It's far more important that you stay the course, so long as the course is reasonable, than which exact course that you're on.
Here's one who someone obviously already knows you, says, I know Dr. Dahle has multiple pages of information available on why one should not get a whole life policy. If he could sum it up in a few points, what would it be?
The reasons why a whole life policy is probably not a good idea for most doctors are that it is a combination of overpriced, unnecessary insurance and a low return investment. That's the best way to sum it up. Now, there are dozens of ways to sell it and all kinds of things you can do with whole life insurance. But most of the time, there is a better way to do those things, a better product to use to meet those needs. For example, if you're trying to save for college, a 529 is almost always better than using a whole life insurance policy. If you're saving for retirement, your retirement accounts and even a taxable account is usually better. If you need a lifelong death benefit for some reason, a guaranteed universal life policy is usually better. The life insurance that most of us need, though, is term life insurance, which is perhaps 1/10 the cost of whole life insurance. And so it's just not a product that most of us need. Unfortunately, we often get kind of sold a policy that we probably wouldn't have bought if we really understood how it worked. And it's not the same decision whether to dump a policy you already have as to buy one that you haven't yet bought. And the reason why is because the poor returns on those are heavily front loaded. And so, you know, it might take you 5, 10, 15 years to break even on a policy. Once you've broken even, the return on your investment might not be too bad from there going forward, because those first 5 or 15 years are already water under the bridge. So it can be a complicated question. If there's any doubt whatsoever in your mind that this isn't right for you, though, don't buy it. There is plenty of time. It is not something that every physician should have because they're a physician. Don't let anybody convince you of that.
What about annuities, especially ones with a floor? A lot of people try to sell you an annuity because it has a floor, and if the stock market crashes, then you'll be safe. What do you think of those?
Yes, there are a lot of bells and whistles that can be added both to cash value life insurance and to annuities. As a general rule, they are overpriced. You're simply paying too much for the benefit. In order to put that floor underneath you, you're giving up too much of the return to get it. That's the usual issue with these. Certainly a physician that is relatively early in their career has no need for that stuff because they can just hold on to the investment. And more than likely, they are going to be able to recoup their investment over the course of the next 10, 20, 30 years and come out way ahead than if they had been paying an insurance company to try to hedge some of that stock market risk for them.
Okay. Does you might not know this one, you may, we'll see. Does a pre-existing diagnosis of depression impact ability to get disability insurance, or do I need to go through GSI?
Absolutely, it could impact that for sure. Any medical condition you've had could impact it. Will it keep you from being able to get it at all? Probably not. It might cost you a little bit more money. You might have a mental/nervous limitation on the policy, in that, you know, instead of paying till 65, it might only pay for 24 months if you are disabled due to that depression. But what you should do is go see an independent disability insurance agent, one that can sell you a policy from any company, and compare what is available to you. And they can kind of shop you informally. They can say this person has depression, they take Prozac, they've never been hospitalized, et cetera, et cetera. And the person on the other end of the line can actually tell them, yeah, they probably shouldn't apply formally with us. They're going to get a rating if they do that. This is how we would treat that. And a different company might treat it totally differently. But in that process, you can also look at a GSI policy, Guaranteed Standard Issue Policy. These are policies that, if you're super healthy and have no bad habits, usually have a little bit higher cost than a standard policy. But if you have some sort of medical condition and your employer or your institution offers a GSI policy, that's often the best policy for you. You know, if you've got diabetes and you've already had a heart attack and you want to get disability insurance, you're going to be far better off with the GSI policy. But with a little bit of depression, it's hard to say. You just have to compare and run the numbers. The best thing to do is to work with an experienced, independent insurance agent that can help you do that.
Awesome. I have a couple of IRA questions. Here's one that came in advance. Says, my husband and I both set up a Roth IRA in residency, and now we're above the salary threshold to contribute. This person would like recommendations on what they should do with that account now. The current retirement plan is a 403B through the employer. This person's going to start a new job in the fall that also has a 403B.
Well, I've got some great news for you. It's called the Backdoor Roth IRA. It used to be, prior to 2010, that a physician couldn't do a lot of things with IRAs because of their income. They weren't allowed to deduct traditional IRA contributions as long as they had a plan available to them at work. They were not allowed to make direct Roth IRA contributions because they made too much money. And they were not allowed to do Roth IRA conversions because they made too much money. In 2010, Congress changed one of those three rules, and they allowed high earners to start doing Roth conversions. And what that opened up is what is now called an indirect Roth IRA contribution, or a backdoor Roth IRA contribution, which, despite the name, is totally legal. Congress knows we're doing it. The IRS has said it's okay. But the way it works is you make a contribution to a traditional IRA. This contribution is non-deductible because you make too much money and you have a retirement plan at work. And then the next day, or a week later, in the case of one of our earlier listeners, you move that money from the traditional IRA to the Roth IRA. That is a Roth conversion. That is a taxable event. But there's no taxes due because that money has already been taxed. You didn't get a deduction when you put it in the traditional IRA. So now when you move it to the Roth IRA, you can do so tax-free. And so the bottom line is, even after you're an attending, you can keep making a Roth IRA contribution for you and for your spouse. You just have to do it through the back door by putting in a traditional IRA first and then moving it to a Roth IRA.
Here's one from a resident. It's actually a compliment. It says, my hospital uses Fidelity. I wasn't sure how to divvy up the portfolio. I went with your advice and went aggressive stocks. I divided it between large gap, medium gap, and small gap index funds. The 5-year performance was good. I chose them because of those published numbers. So a little kudos there.
Well, that's great, although I'd be careful choosing your investments based on past performance. There's a reason why every mutual fund prospectus is required to contain the words, past performance does not indicate future performance. Now, the stock market has done particularly well the last 10 years. And so any past performance numbers you look at over the last 5 or 10 years that involve investing heavily in stocks are going to look pretty good. But having been an investor in 2008, I can assure you that stocks go both up and down. And so when setting your asset allocation, your mix of stocks to bonds to real estate to other assets, make sure you do not pick something that is more aggressive than you can hold in a 2008-like scenario. It's a little bit like The Price is Right. You want to get as close to your risk tolerance as you can without going over. Because if you go over, what happens is you're lying awake at night and your spouse is asking you, why'd you lose all that money we were going to use to remodel the kitchen? And all of a sudden you find yourself selling low, which is a financial catastrophe. You would be much better off being a little bit less aggressive the whole time and not panicking in a market downturn than you would going ultra aggressive. So you really just have to know yourself, but I caution people to really err on the conservative side until they pass through a bear market. Now, a lot of us recently did. I mean, if you were paying attention in December, the market dropped 20% in December. And if you were able to sleep through that and able to keep investing and so on and so forth, then you're probably okay with what your asset allocation was. But if you found yourself lying awake at night on Christmas Eve and you weren't listening for the reindeer, you might want to rethink that asset allocation. And now that the market's recovered, this is a pretty good time to dial the risk back a little bit.
Here's another IRA question. This person says, I like the Roth. Is the Roth IRA a good IRA to fund out of residency, or would you recommend a Roth 401k or a traditional solo 401k?
I'm not sure exactly what we're talking about out of residency. During residency, the general rule is that you want to use Roth accounts just because you're in a relatively low tax bracket. And then when you're an attending, you generally want to use tax deferred accounts, particularly after that first year where you're half year resident, half year attending. But after that, you want to be using tax deferred accounts if at all possible, just because you're now in your peak earnings years. But if for some reason a Roth account is right for you, the first thing you look at is your employer's account. If they are offering you a match, if you put money in the Roth 401k, they give you some money in that 401k. You want to make sure you get that match. That's free money. Not getting that is like leaving part of your salary on the table. But in general, after the match, I prefer a Roth IRA to a Roth 401k just because the expenses are usually a little bit lower. I have a few more investment choices. I have a little more control over it. And so, you know, obviously I would try to do them both. I'd try to max out both your Roth IRA and your employer account. But if you have to choose, I'd probably choose the IRA over the employer account once I've got the match.
Got it. Yeah, we're getting a lot of questions. We'll go quickly here. What are your thoughts on practicing in a rural community in terms of cost of living, potentially higher income, et cetera? I'm a medical student, newly matched, and I had a goal of practicing rural, but wonder what insight you might have. Thanks for everything you do.
Well, I tell you what, I am amazed how many doctors there are living in California. And I know I saw a few names here in the question list that I recognize, people that I interviewed with for residency, actually, who practice in California. So I know there's a few of you out there. But an expensive area like the Bay Area, where doctors may not get paid anymore, sometimes even less than similar professionals, and you have a high tax burden and you have a high cost of living, it's definitely a much steeper road to climb to financial success than if you live in one of the flyover states like I live in, where taxes are lower, cost of living is lower, and oftentimes physicians are paid more, particularly if it's not a very desirable place for emergency physicians to go to. It can be amazing how much money you can make as an emergency physician. And so I think it's, if you find a place that you are happy living in that doesn't have a high cost of living, that has a low tax burden, go there. You know, by all means. It's like what I tell medical students, you know, if they find themselves in love with orthopedics and pediatrics equally, pick orthopedics. It's going to pay you 3 times as much. But if for some reason you are in love with California or DC or Manhattan, and that's where you want to spend your life, a physician still makes enough money that if they manage it wisely, they can still have a very nice financial life there. You just got to realize that you can really put some wind at your back by moving to some of the lower cost of living areas.
Would you recommend converting traditional IRA money to Roth in order to take advantage of the expanded 24% tax bracket?
That's a good question. It really depends. It depends on a lot of your financial scenario. Obviously, if you think you're going to be taking money out in retirement at some level higher than 24%, and you can convert now at a tax rate less or equal to 24%, then that makes sense. You know, but Roth conversions are one of those things that it really depends on the rest of your financial picture. Yes, it depends somewhat on what future tax rates are going to be, but more of it depends on you. And so I can think of scenarios where it would make sense to do a Roth conversion at 24%, and I can think of scenarios where it would not make sense to do a Roth conversion at 24%. The devil's really in the details there, and unfortunately, we don't have any.
Here's a long one. It came in before the webinar started. It says, I haven't seen much in posts about medical reimbursement plans for a small business, something my CPA recently told me about when I heard I have a high deductible health plan. From what I can tell, it's great for us since we have a small business with just family as employees that's organized as a C Corp. All of our out-of-pocket expenses and health insurance costs are deductible as business expenses, much better than on the 1040 personal side. Curious if this is something relatively new and if there are any gotchas to look out for. Any guidance on how big a pot to accumulate in the HSA is appreciated too. We are both 60 and the plan for now is just to keep accumulating, but I wonder about when it could be too large and cause an inheritance tax burden for my heirs.
Okay, so there's 2 or 3 questions in there. Let's talk about the first one to start with. This is the idea of a health reimbursement account, or an HRA, they're often called. The problem with these accounts is that they make it so you can't use a health savings account. And so the typical use for this is for employees. So what you do is you basically, the employer gets a high deductible health plan and then uses an HRA to basically convert that high deductible health plan to a low deductible health plan. So let's say the deductible was $2,500, and so they install an HRA, which will pay everything from $250 to $2,500. And so basically now your deductible is $250. So it's a great benefit for employees. They love it, right? They now have basically a really nice health insurance plan. And sometimes that's a cheaper way for the employer to go. Rather than getting a lower deductible plan, they're better off with a high deductible plan than an HRA. The problem is they are not compatible with HSAs most of the time. The only ones that are limited HRAs that you can only use for, optometry, sometimes dental, that kind of a thing, but you can't use it for your main health care expenses. And so that doesn't really work very well as far as using it with an HSA. Now, if the right healthcare plan for you is not a high deductible health plan, then an HSA plan might not make sense for you. But if it does, then for sure use the HSA. A health savings account is probably your best investing account out there. And the reason why is it is triple tax-free. Just like a 401k, you get a big fat deduction when you put the money in. For a family this year, it's $7,000. For a single person, that's $3,500 that basically is not taxed at all by being put in an HSA. And then as it grows, it's tax protected, just like a Roth IRA or a 401k. When you take the money out, as long as you spend it on healthcare, it comes out tax-free, just like a Roth IRA. So it's a triple tax-free account. It's a wonderful way to invest. In fact, there's no reason to not max it out if you are eligible to use it each year. And the reason why is because after age 65, you can take the money out penalty-free and use it on anything you want. You can buy a sailboat with it if you want and pay no penalties. Now, you will have to pay taxes on it if you use it for a sailboat instead of healthcare expenses, but that's no different than your 401k. So at its worst, it's as good as your 401k. So feel free to max that out each year. It really can't get too large. Now, you do want to use it for healthcare during your lifetime, if at all possible. It's not the greatest account to inherit because it's all taxable income to your heir in the year you die. So you definitely, this is money you want to spend. They would be much better off getting your Roth IRA, even a traditional IRA or a taxable account or your house or something else. This is something you probably ought to try to spend during your lifetime, but I wouldn't hold back funding it. All the estimates of how much money you're going to spend on healthcare and retirement are quite high, and chances are very good you're going to run through that money at some time during your retirement.
Here's somebody moonlighting during residency and asks, how should they use the extra money?
Well, the typical issue for a resident isn't that they don't have any uses for some extra cash. Usually the problem is they have too many uses and not enough cash. So it depends on what, your highest priority use is. It's hard to say. Here are a few options, though. A lot of residents are still carrying credit card debt and car loans and consumer debt. If that's 8, 10, 12, 15%, that's a pretty high priority. So that's probably what I do first with any extra money I had. Another great option, anytime you're moonlighting and basically getting 1099 income, that you're an independent contractor, is to open an individual 401k. And in residency, that can even be a Roth 401k. You can put the money in there, after tax basically, and have it never be taxed again. So that's another great use for it. You can use it for a Roth IRA. You can also use it to pay down student loans. If you are planning on paying down your student loans yourself, rather than trying to go for a government forgiveness program, that's also a good use of your money. Maybe saving up a down payment toward your dream house might be a good use of it. If you're already owning a house in residency, maybe you want to pay down your mortgage with it. There's lots of good uses for it. Even just saving up a real emergency fund that a lot of interns don't have when they first start out. There's hardly a bad use for it. I mean, it's probably even okay to spend a little bit of it, right? I mean, you got to have moderation in all things, and a little bit of balance in your life. But I rarely run into somebody who doesn't have a good use for their money. Usually by the time you're having that problem, you're already financially independent.
What are your thoughts on investing in equity options for real estate crowdfunding companies? Can you review the benefits of the REITs?
There's a lot of things mentioned in that question. Let's start with the last one. REITs or REITs are real estate investment trusts. There are lots of different ways to invest in those. Probably the easiest way is to go to Vanguard and buy shares in their mutual fund, the Vanguard REIT Index Fund. It's very, very cheap, very broadly diversified, very liquid. And I think it's a reasonable place to start with any sort of real estate investing. That's a fund I invest in. I don't get paid any money by Vanguard to be a shill for them for that. Something I've invested in for a long time. The downside of that particular fund is it moves up and down with the stock market somewhat. It's moderately correlated with the stock market. And so some people prefer investing in real estate in other ways, whether that is buying properties directly and managing them themselves or hiring a manager. Sometimes it's doing syndicated real estate, where you hire a syndicator, basically puts together 100 investors, and they buy an apartment complex and basically share the economies of scale with that. Sometimes there are some of these companies, especially since the 2012 Jobs Act, that are basically raising money and doing crowdfunded investments. And these are essentially syndications, where they bring a bunch of investors together online, and they each put in $5,000 or $10,000 or $20,000 toward an investment, and then the manager runs the investment. One of the newer things we're seeing are some of these private REITs put together by these same companies, such as Realty Mogul or Fundrise, these kinds of companies. And they are basically offering a REIT that you can buy in and buy out of. It provides a little bit more liquidity than those syndicated investments. It gives you a little more diversification because it might have 10 or 15 properties in there instead of just one. And of course, with the new tax law, there's a slight tax break there for investing in a REIT. Basically, 20% of your REIT income is now a deduction. And so that helps a little bit, but they're terribly tax inefficient already inside your taxable account. Those are all reasonable ways to invest in real estate. I've done all of them. I don't know that one of them is necessarily better than the others. You're really on a spectrum from how much control you want to have over the investment and how much hassle you're willing to put into it. The least hassle, least control option is to go to Vanguard and buy the REIT index fund. The most hassle, most control option is to buy the house down the street, rent it out, and manage it yourself. And everything else is kind of in between. It just depends on how much hassle you're willing to deal with to have more control over the investment.
Here's a question we can probably roll into one. Somebody wants to know what is your personal bond strategy, and someone else asks if you do any market timing.
Well, I don't do any market timing. That's an easy one. Basically, I have a written investment plan, and we just follow it. We've been following it since 2004 when I was a resident, and it certainly worked well. 7 years out of residency, my wife and I were millionaires. Now we're financially independent. I'm only 43 years old, and basically medicine is optional for me. And not just optional because I got this business on the side, this white coat investor business, but optional because I've saved up enough money that I don't have to work anymore. And so you don't need a complicated plan if you fund it adequately. Any reasonable, simple plan that you follow, if you fund it with a decent percentage, I usually recommend 20% of gross of a physician's income is going to be adequate. So don't feel like you have to make it complicated and have some crazy market timing scheme. Most of the data shows that market timing is expensive and ineffective. And so I would caution against that. The first part of the question was my personal bond strategy isn't necessarily the best strategy, but what I do is I split my bonds 50-50 between nominal bonds or regular old bonds and Treasury inflation protected securities, those that are indexed to inflation. And some years the nominal bonds do better, and some years the TIPS do better. It just depends. But that's been my strategy for the last 15 years, and we're basically still following it. If I could go back in time, I'd probably pick something different because now I know what happened. But That's the strategy we're using because we feel like it's a good know-nothing strategy that's worked well for us. I happen to have access to the government thrift savings plan from when I was in the military. And so a good portion of my nominal bonds are actually in the TSPG fund, which is basically a money market fund on steroids, bond yields with money market risk. But that's not accessible to most investors. And so it's hardly something I can recommend across the board.
Can you explain how tax gain and loss harvesting works? Once you switch to a similar fund, can you later tax loss harvesting by selling and moving your investment back to the original fund?
Okay, so let's talk for a minute about tax loss harvesting. The idea behind tax loss harvesting is to get a loss that you can use on your taxes without actually changing your portfolio in any significant way. So you're just harvesting the loss to use on your taxes. So the way this might work, let's imagine last December 1st, you bought $10,000 worth of the total stock market index fund at Vanguard. And then come Christmas Eve, you'd lost a bunch of money. You'd lost a couple $1,000s on that by that point. And so what you decide to do is let's exchange it for the Vanguard 500 index fund, which is very, very similar. The correlation between those investments is 0.99, but they are different investments. They are not substantially identical. Those are the words of the IRS, substantially identical. And so you can switch one for the other. And what you've done there is you've booked a $2,000 loss, and you can use that now against your taxes. Each year, you can use up to $3,000 in capital losses against your regular earned income. Above and beyond that, you can use it against your capital gains and also carry any losses you have forward. For example, I booked about $80,000 worth of losses last December, and I only got to use 3,000 of them this year. I think I offset some capital gains I had, maybe another 3,000 or 4,000, and the rest I'm going to carry forward and use in my taxes next year. And maybe I'll be able to carry them forward for a decade. And so it's pretty useful for reducing your taxes. Now, the downside of it is, aside from the hassle having to put in those trades, is that it lowers the basis on your investment. So when you eventually do sell it, you end up paying taxes on more of it than you would have otherwise. You still come out ahead, but it's not a free lunch for sure. The only way to get the free lunch is to die. If you die, your heirs get a step up in basis, or to donate those shares to charity, which is always a great tax strategy if you're giving a charity anyway. Give them appreciated shares, then neither you nor the charity have to pay taxes on them. So if you can combine those two things, tax loss harvesting with the donation of appreciated shares, it's really a powerful way to invest very tax efficiently. Now, the questioner also asked about tax gain harvesting. Now, this is kind of a different strategy, not one used by attending physicians very often, but occasionally there is somebody, a child or college student, or maybe a resident even, where you are in the 0% capital gains bracket. And you can literally harvest capital gains with no tax consequences. And what you're doing there is basically raising the basis of your investment. And so when you later sell it, when you're in a higher tax bracket, you then won't have to pay taxes on it. And so that can be a good strategy too, but it's one you employ in a very different year than when you're employing tax loss harvesting. Now, the other part of that question was, what about exchanging back? And the only rule about exchanging back is you got to wait 30 days. So in my example, where you bought total stock market on December 1st and you exchanged it for a 500 index fund on December 24th, you got to wait till January 24th or 23rd, whatever 30 days is, before you go back to the total stock market index fund. This year, that might not have been a great move because by that point, the market had already recovered. And so when you exchange into a fund, you'd better make sure it's a fund you're willing to hold for a long time because you might be stuck there or else have to pay a lot of capital gains, which are basically going to wipe out the losses you just harvested. So make sure you're swapping into a fund that is not substantially identical, that still has pretty high correlation with the original fund, and that you're happy holding indefinitely.
Excellent. Is there a way an employed physician with W-2 with access to a cash benefit plan can take advantage of the 199A deduction if he or she can lower income enough? Would incorporating help?
An employed physician does not qualify for the 199A deduction. This is the qualified business income deduction. If you don't have business income, you don't qualify. Now, if you are an independent contractor and your income is low enough, this is talking about doctors because doctors are a specified service business. If your income is low enough and you are self-employed, you can take that deduction. But bear in mind, there's a few caveats. One, if you're in a partnership like mine and your payments are guaranteed income payments, they show up on box 4 of your K-1, those don't count as qualified business income. Only ordinary business income does. So a lot of partnerships are scrambling to see if they can, change their business structure around a little bit, change their payment structure around a little bit to get practicing physicians this deduction. But in a lot of cases, like my partnership, they just weren't able to do it. And so our partners aren't getting that deduction. It's fine. A lot of them wouldn't qualify for it anyway because they make too much money. But there's a few people that kind of got hosed because we weren't able to do that. But having a cash balance or a defined benefit plan isn't going to help in that situation if you're an employee. If you are a business owner and you can use it to lower your income to less than 415,000 is the end of the phase out range for married people. If you can use that retirement plan to lower your overall taxable income into that range, you may be able to qualify, but it's still got to be business income. It can't be employee income. That doesn't count.
Here's somebody who has a high income, 600 plus, also a high saver, maxing out profit sharing in 56K. Currently 37K pre-tax through group and Roth 19K individual. Typically, you recommend pre-tax for 401K. Would you still recommend pre-tax for the 19,000 portion with profit sharing?
Well, here's the deal. There are some exceptions to the general rule. The general rule is you use a Roth account as a resident and you use a tax-deferred account as an attending. One of the exceptions is for a super saver. If you are just saving a ton of money and you're going to be in a very high tax bracket in retirement because you're saving 30 or 40 or 50% of your income, that is probably an exception to use a Roth account during your peak earnings years. But bear in mind, you're a pretty unique physician. Most physicians, I have to talk into saving 20% of their income, and that's really a difficult thing for them. And, at those kinds of levels, I think you're far better off using a tax-deferred account. So I don't have enough information to really answer that question for you. I have a post on my website called Should You Do Roth 401k Contributions, which goes through those exceptions. I think that's worth spending some time on and really looking at your situation and how long you plan to work and how long you plan to continue to save as much as you are. And you may come to the conclusion that not only do you want to do Roth 401k contributions, but you might want to do Roth conversions even during your peak earnings years. But that's unique. Most physicians are going to find they want to use tax-deferred retirement accounts throughout their peak earnings years.
Here's somebody who says, I have the opportunity to invest in a non-qualified deferred compensation plan. They sell it as an extension of the 401k once you max out your work 401k. But with the NQDC, it is basically an overfunded whole life policy. The company is stable, and I don't think it will go under taking an investment with it. I know what your stance is on whole life. What's your take on this as a way to get more tax-deferred money?
Well, here's the way I look at it. If somebody else is going to buy me a whole life insurance policy, I'll take it. But I'm not going to use my money to buy it. And so that's kind of how you have to look at these. Every one of them is individual. And, it's interesting because if your employer is paying all the premiums, well, there's only one loser in that scenario, right? The agent selling this plan to the employer really made out like a bandit. And since you're not putting anything into it, you're making out like a bandit, even if you might rather have a higher salary rather than that particular benefit. And the only loser there is really your employer because they probably could have gotten a lot more bang for their buck by doing something different with the money. So I'm not a huge fan of them. I certainly wouldn't recommend employers go out and put these in place. But if your employer is going to pay all or most of the premiums for you, why look a gift horse in the mouth? It's not that a whole life insurance plan has no benefit whatsoever. Worst case scenario, when you walk away, you cash it out and you take the money. And so I wouldn't necessarily be against using it if it's already in place, but there's no way I'd be putting that in place for my business.
Here's another 1099. It says, if given the choice of W-2 or 1099, is there any benefit of 1099 in terms of deductions? Is this recommended altered by the new pass-through deduction?
Okay, well, let's talk a little bit about this. A W-2 means you are an employee. You're somebody's employee and you're paid accordingly. The employer has to pay half of your payroll taxes and they usually provide you some benefits. If you are paid on a 1099, you are an independent contractor. You are self-employed. You are in business. You can incorporate or be in a partnership or whatever, but even if you don't do anything and they just hand you a 1099, you are by definition a sole proprietor. And when you are a sole proprietor, you file Schedule C every year with your taxes. And on Schedule C, you put all of your business income and all of your business expenses. Okay? Those are the best kinds of tax deductions you can get. The great thing about a business expense is you don't pay any payroll taxes on it. You don't have to itemize to get it. You don't. It's great. It's the best type of deduction there is. Whereas if you're trying to get another deduction as an employee, sometimes you can't deduct it at all. And that's why a lot of employees have a CME fund, right? The employer provides the CME fund because that makes it deductible to the employer. But an independent contractor can just pay for that sort of thing pre-tax already. And so, yes, there's a lot more things you can deduct when you are an independent contractor. But bear in mind, that doesn't mean that getting paid on a 1099 is always better than being paid on a W-2, because you also have to pay the employer's half of your payroll taxes, the Social Security and Medicare taxes, and you have to buy all your own benefits. So I think in general, for an emergency physician, you should expect to be paid about 10% more if you're being paid on a 1099 versus a W-2. So if you were making $350 on as a W-2, I would expect to be paid $385 as a 1099, and those are going to be about equivalent. So there's a lot that goes into it. You can run the numbers yourself, but that's kind of the general rule of thumb.
Excellent. There's probably no way we're going to get through all of these. They just keep coming in, but we'll keep going here for another 20 minutes or so. Should we have any bonds at present in the 401k retirement fund or backdoor Roth when we're not going to use the money for at least 22 years till we hit 59 and a half? So this is a mid-30s position.
Well, here's the question, right? What did you do in 2008 with your investments? And the chances are, if you're in your mid-30s, you weren't even investing in 2008. And so you have no idea what your risk tolerance is. So question number one is, can you tolerate the volatility of a 100% stock portfolio? And I really don't think you know that for sure until you've invested through a nasty bear market. Warren Buffett's mentor, Benjamin Graham, said you should never have more than 75% of your portfolio in stocks or less than 25% of your portfolio in stocks. And I think that's a reasonable general rule. The reason why is twofold. One, it helps moderate the volatility of the portfolio. It makes it easier to hold it when money is going down, or when the value of stocks is going down. And unless you've been in that situation, it's hard to comprehend. It is not an intellectual exercise like looking at graphs are on the internet or looking at them in a book, when the markets aren't doing anything particularly interesting. It is an emotional exercise. It is something you feel in your gut. You're basically looking at money that you could have used for a new truck or for a kitchen remodel or for a very nice time in Fiji, and it's gone. It's really gone. It's like you stuffed money down a rat hole and it's totally gone. And that starts hitting you in your stomach. So don't overestimate your risk tolerance. I would recommend you have at least a little bit of bonds until you've gone through a bear market and know how you react in a bear market. The other thing to keep in mind is there is no guarantee that stocks are going to outperform bonds over the next 22 years. Is it likely? Sure, it's likely, but there's no guarantee. And so I think it's reasonable to hedge that bet a little bit and put at least a little bit of your money into bonds, maybe 10%, maybe 25%, something like that. That's not going to cost you a lot out of the return department. It will cost you something if stocks do what they've done in the past and outperform bonds, but it probably won't cost you all that much, and it will likely help you sleep better at night. And who knows, this might be one of those decades where bonds outperform stocks. It does happen from time to time.
Here's somebody who is finishing fellowship, entering private practice, and has some money from a 403B from residency. What should this person do with that cash?
Okay, if you are entering attending hood this year, meaning you're still a fellow, then what you ought to do is when you leave fellowship, just convert it all to a Roth IRA. And the reason why is you're only going to have half of an attending salary this year. The other half is going to be a fellow's salary. And so it's a relatively low income year for you and a great year to do a Roth conversion. So that's what I'd do. What I'd try to do beforehand is I'd try to just use the Roth 403B available in residency and fellowship rather than converting it once you become an attending. That's probably the next best thing. Another option, if you just don't want to pay the taxes, if you can't, if you don't have the money or just don't want to for whatever reason, is you can just roll it into your next 401k. Be careful, however, with what used to be the default option, which was rolling it into an IRA. If you just roll it out of that 403B into an IRA and leave it there, it's going to cause you some complications with the backdoor Roth IRA process due to what's called the pro rata rule. Basically, it says you've got to empty out your IRAs, including SEP IRAs, by December 31st of the year you do the Roth conversion. So just be aware of that, that's not really a good move for doctors to move money from 403Bs and 401Ks into a traditional IRA.
Here's someone who says, in the current economy, which one would you prioritize? Paying a home loan at 4% interest, or keep investing in a brokerage account after maximizing a retirement account?
Okay, so this is a crystal ball question, right? If the market's going to go down in the next couple of years, you should pay off the debt. If the market's going to go up, you should invest it in, stocks. I don't know which of those is going to happen, so I can't answer your question. And so I think you just need a written plan and follow your plan, whatever your plan might be. If you're really not sure what to do, just split the difference. Invest half of it and use the other half to pay down debt. But the only way to know the answer to that question is to know what the future holds. And not only do I not know what the future holds, but I know that neither does anybody else. And so don't go looking for a guru that can predict the future. Everybody's crystal ball is cloudy. Nobody knows nothing. And once you realize that, it frees you up to concentrate on what really matters in becoming financially successful. And that's getting your income up, carving out a big portion of it to invest, getting rid of your debt, and investing that money in some sort of reasonable way and staying the course with that plan. And you can quit focusing on, oh, what's GE going to do next month? And what's Apple going to do? And what's the stock market going to do? And what are interest rates going to do? Because that is not only information that you don't know, but it's unknowable.
Did you go into real estate personally yourself early when you started getting interested in finances?
No, I didn't go into real estate all that early. I guess my first real estate investment was kind of an accidental landlording situation. Like many people who bought a home in 2006 and needed to move in 2010 or so, we couldn't sell our house. We ended up being long distance landlords from another state, which was pretty unpleasant and not very profitable. And so that wasn't too early. That was 4 or 5 years out of residency before I was starting to do any real estate investing above and beyond a REIT index fund. Since then, I've gradually converted more of my portfolio to real estate. I've got about 20% of my portfolio in real estate now. And I've invested in a lot of different ways in real estate, but I wouldn't say it's something that you have to do early on. But also, I wouldn't say it's something you can't start doing early on. It really depends on your interest. Some people have 20% of their portfolio in stocks and bonds and 80% in real estate, while other people may have 80% of their portfolio in stocks and bonds and 20% in real estate. I wouldn't even feel like real estate is mandatory. I think it's an optional asset class that you don't have to invest in. As a physician with a reasonable savings rate, you can avoid it completely and still be very financially successful.
For self-employed private practitioners and sole proprietorship doing well financially, would you consider SEP IRA bunk and rather go for self-employed 401k to get Backdoor Roth? Is it too late to open a 401k for 2018? Thanks for everything you do.
Okay, so this is the classic solo 401k or individual 401k versus SEP IRA question. A SEP IRA is generally inferior for doctors for 2 reasons. 1, you need more income to max it out. And 2, it keeps you from doing a backdoor Roth IRA due to that pro rata rule. That said, it has a couple of advantages. 1, it's pretty easy to open. It's a little bit less paperwork than a 401k, both to open it and to maintain it. And 2, you can open it after the end of the year. A solo 401k, you have to open by December. You don't have to fund it by December, but you have to open it by December. A SEP IRA, you can open on April 14th and fund it. And so what a lot of people do when they realize they've missed the deadlines is they open a SEP IRA right now for 2018, they fund it, then they open a solo 401k for 2019, and they roll the SEP IRA in there. And that takes care of both issues. It allows you to use the benefits of both of those accounts. But in general, going forward, you probably don't want to be using a SEP IRA. One word of warning, Vanguard's individual 401k does not accept SEP IRA rollovers. So if you're doing that strategy, you might want to look somewhere else like Fidelity or E-Trade to open your individual 401k.
Here's a couple planning to marry soon. Says, as a newly matched dual physician couple, which is better, repay or pay?
Oh, that gets complicated. But assuming you both have loans, the right answer may very well be repay. The reason some people use PAYE is because one of them is going for public service loan forgiveness. So what they do is they file their taxes married filing separately, and they try to keep the person going for public service loan forgiveness income very low, so their payments are very low, so there's more money left over to be forgiven. But in that sort of a situation where you have a dual income couple, it's probably worth paying $200 or $300 or $400 to a student loan specializing advisor to get advice on your student loans, because it could make a difference of tens of thousands of dollars. The easy answer when you're married to a non-earner or when you're single is to just do REPAYE. But once you have a dual earner situation, it becomes pretty complicated pretty quickly, and it's worth getting some advice to decide which retirement accounts to use, how to file your taxes, and which student loan payment program to be in.
Here's a tricky one. Should higher earners like physicians use a CPA that costs around $2,000 to do taxes, or just do it yourself? Are you at greater danger of IRS tax audit if you just do it yourself?
Well, here's the deal. You want to make sure it's done right. So either way, make sure it's done right. If you're going to do it yourself right, that's okay. You just saved yourself $2,000. For most physicians, they don't enjoy tax preparation. And so, it's a little bit painful to do that. I don't mind it as much, but you know what? Sometimes it's a pain for me too. I prepare my own. One benefit of doing that I've learned over the years is it's taught me the tax code. I'm able to talk to you about the 199A deduction because I just spent some time going over how to get it, earlier this morning. And the reason why is because I do my own taxes. I don't feel like you have to do your own taxes to learn the tax code, but I think it's important that you pay attention to what your tax preparer is doing. When they hand you back your forms, don't just sign them and send them off. Look at them, understand what's going on and how income and deductions flow from one form to another. And I think that's a worthwhile lesson to learn. And one benefit of preparing your own taxes is you simply realize how the tax code works and you live your life a little bit differently in a way that lowers your tax bill and increases how much you can invest and spend and give. So no right answer there. Nothing wrong with hiring a CPA. Make sure they're doing a good job, obviously, but don't feel like it's something that you can't do yourself. It's not that complicated. Most of you have a much less complicated financial life and tax situation than I do. And sometimes it's really not that hard, especially if you're just a W-2 employee with a couple of deductions. It's just not that hard to do your taxes.
Since robo-advisor managed taxable accounts have mostly been created during a bull market, do you think it'll manage well in a bear market, assuming already maxed out tax protected accounts?
Okay, so here's the deal with a robo-advisor. All a robo-advisor is a company that for a low fee will make sure you have a reasonable investing plan. That's it. That's all a robo-advisor is. They basically take the investment management service that you would get from a financial advisor and they commoditize it at a low price. And so what do you mean, will that do well? Well, what are you invested in? It doesn't really matter that you're using a robo-advisor. It matters what the underlying investments are. If you chose a very conservative way to invest and the market does terribly, you'll be sitting well. If you chose a conservative way to invest and the market does great, then you won't have done as well with that. On the other hand, if you chose to invest aggressively through that robo-advisor and the market does well, you'll be sitting pretty. If the market tanks and you were invested aggressively, you're not going to do great. But little of that has to do with the robo-advisor, especially if you choose one with a very low cost structure. The main problem with robo-advisors, they usually don't manage all your money for doctors. They usually only manage IRAs and your taxable account. And so here's the way I look at it. You've probably got 2 or 3 other accounts. You probably have some 529s and you probably have a taxable account somewhere and you probably have a 401k and maybe your spouse has a 403b. And if you're going to hire a robo-advisor to manage 2 of those accounts, who's going to manage the other ones? If you can manage the other ones yourself, you don't need the robo-advisor for your IRA and your taxable account. If you're going to hire a financial advisor to manage those other accounts, then why not just have them do all the accounts? And so I think the percentage of people for whom a robo-advisor is right is actually a pretty low percentage of people.
Well, breaking up is hard to do even in finances. Here's someone who says, how do I say goodbye to my financial advisor who I've worked with over several years?
Well, it sounds like you've already made the decision to fire him, and hopefully it's not your brother-in-law. Those are the hardest ones to fire, right? Because part of the gig for a lot of these, I should put advisors in quotes because a lot of them aren't advisors. They're just salesmen. But part of the gig they do is they get in with you. They become your friend. and they make it difficult to be fired. And so that's part of the strategy. Realize that. Also realize that even though it's your first time firing a financial advisor, it's not their first time being fired. In fact, the worse an advisor they are, the more likely they are to get fired all the time. The truth of the matter is you probably don't even have to talk to them if you don't want to. You'll have to look at the contract you signed with them. You may have to give them notice. And if you do, you can shoot them an email. But what a lot of people do is they just go to wherever their assets are going to be held, Vanguard, for instance, and they fill out the paperwork, and Vanguard pulls the money from the old financial advisor. And you don't even actually have to talk to them. So the first thing to do is figure out what you're going to do going forward. There's no rush to fire them. Figure out what you're going to do. Either get a written investment plan in place yourself or hire your new financial advisor and then move the money. There's no big rush. Just because you've been getting kind of crummy advice, it's okay to spend a couple of months learning a little more about investing and getting a written investment plan in place, and then move the money when you know what you're doing. But how do you fire them? You just pull the assets away from them most of the time. That's it. If your contract says you got to give them notice or tell them to stop transacting on your benefit, well, shoot them an email or give them a call. The typical approach I would take is say, thanks, I appreciate what you've done for me over the years. I really didn't know anything about this when I first came to you, so I appreciate you taking care of the basics, but I'm kind of ready to move in a different direction now, and so that's why we're moving the assets away. And, let them down easy. This isn't the first time they've heard it, though, I assure you.
With an inheritance or a lump sum, would you generally place the proceeds in your predetermined allocation, or would you dollar cost average?
I'm not a big fan of dollar cost averaging. The reason why is the right thing to do most of the time is to just invest the lump sum. And that's because the market goes up 2/3 of the time. Now, of course, it goes down 1/3 of the time. So if the market's going to go down, you should definitely dollar cost average. In fact, just wait till the market goes down and put the money in. But obviously, your crystal ball is cloudy, just like mine, and you have no idea what the market is going to do in the future. And so the most likely thing that's most likely to earn you the most money is just lump sum it. But if you feel like you just can't do it, well, feel free to dollar cost average it, but don't drag it out over multiple years. Get it in there within a few months and then stick with it. But the truth of the matter is, if you're hesitant to invest the money in all at once, you probably have too aggressive of an asset allocation. Maybe you ought to dial that back a little bit. It also is a little bit easier when it's a relatively small amount of money compared to your overall portfolio. For example, let's say you have a couple $1,000,000 and you just inherited $100,000. That's probably not going to bother you much emotionally to just invest that right into your asset allocation. On the other hand, if you have a $100,000 portfolio and you just received a $2 million inheritance, that's probably emotionally going to be a little bit harder if you put it all into the market right now and the market drops 20% this month like it did in December. And so maybe you need to care a little more about emotionally how you're going to react to that, and either dial back the asset allocation or invest it over a few months. Either one's fine, but keep in mind what you're doing, right? You're just kind of using dollar cost averaging as an emotional crutch. In reality, you probably ought to just dial back your asset allocation a little bit and invest it all tomorrow.
All right, we have time for a couple more. That hour went fast. It says here, I still have about $3,500 a month left over if I'm looking to save 20% of my gross income. After 403B, 457, Backdoor Roth, would you suggest the next step be a taxable account or a solo 401k with a side business?
Well, if I had side income, I'd use a solo 401k before I used a taxable account for sure. No question in my mind. The reason why is you get not only that additional tax protection, which will boost your long-term returns, but you also get additional asset protection in most states. And so for sure, max out everything that's available to you as far as retirement accounts before you invest in a taxable account. The only real reason to use a taxable account when you haven't maxed that stuff out is if there's an investment that you can only get in a taxable account. For example, maybe you're buying into a surgical center or a freestanding ED or some real estate deal that you can't put into a IRA or 401k. Those are kind of reasons that you might want to consider investing in a taxable account before you've maxed out your retirement accounts. But most of the time, you want to max out everything you can before you go to a taxable account.
I think we have time for one more. Let's go with the question that just came in a couple of minutes ago. I have a Roth and about $300,000 in traditional IRA, maxing out 56K pre and post tax. Should I still change the TIRA to 401k and use the Blackfoot Roth?
I think he's talking about the backdoor Roth, not the Blackfoot Roth. If he is talking about the Blackfoot Roth, I have no idea what that is. But yeah, so the strategy a lot of people do in this situation is they roll the traditional IRA into the 401k. That eliminates the pro rata issue with the backdoor Roth IRA. And so once you've gotten rid of the money in that traditional IRA, you can go ahead and do a backdoor Roth each year by putting $6,000 into that traditional IRA and moving it to a Roth IRA. And so, yeah, that's a reasonable strategy. You know, if you're 65 or something, you're only going to work one more year. Maybe it's not worth the hassle. But, you know, if you're 50 and you're going to work for another 15 years, sure, might as well. There's a lot of benefit to doing a backdoor Roth IRA for 15 years.
We're about out of time. That was a lot of fun. I think based on the all the questions that came in and all the questions that we actually didn't get to, I think we're going to have to ask you back.
Yeah, we may have to do this again. Certainly in the meantime, if people have burning questions, there's a lot of ways they can get them answered. We have a White Coat Investor subreddit for those who like to be on Reddit. We also have a White Coat Investor forum on the whitecoatinvestor.com site where you can ask questions. A lot of smart people will answer them there. We also have a private Facebook group that questions like these get answered on all the time, and you can get on there and ask those questions. You can even shoot me an email if you like. My email is editor@whitecoatinvestor.com. And so far in 8 years, I've gotten back to everybody that sent me a question. You know, I don't know that I'm going to be able to keep that up forever, but so far I've been able to answer your questions individually too. So don't feel like there's nobody out there to help you. There's a whole community online of people that want to help you become financially literate and financially successful. So you're certainly not alone out there.